Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Ty. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about how you create income from your investments or your retirement plans. After all, that's really the end game. You worked your whole life to put money away. You worked your whole life to invest. So eventually when you get to retirement, you can do what? Start taking income from these accounts to live off of for the rest of your life. So that is really what you want to do, is you want to start preparing for income production before you really get into retirement. You don't want to retire and just think that you can turn the key and all of a sudden all of your investments and retirement plans are going to maximize income production. You need to start working towards that. But we're going to talk about all the ways that you should look at creating income from your investments or retirement plans. We're going to start out with some of the most basic first and then go on from there to things that are a little bit more complex. But the obvious one and the first one is CDs. We see a lot of people that carry cash positions, whether it's in retirement or pre-retirement, and they carry CDs for obvious reasons. It's either to keep some liquidity on hand for an emergency fund, or they need it for certain expenses, or it's used for travel and for wants versus needs. And then once in retirement, some of these people are looking for CDs to give them a better rate of return than, for instance, money market or savings or a checking account. However, CDs can be laddered. There's a term called laddering CDs. And what you do is you stagger them based on the expiration and start date. So you constantly have a flow of expiring CDs giving you an opportunity to purchase or pay bills, expenses at different times. It also gives you the opportunity, a lot like dollar cost averaging, where you're able to go in and get the current interest rate. Sometimes it might be lesser than when you first put the CD into place. Sometimes it might be better. But by laddering CDs so they come to expire at different times gives you an opportunity for a little bit more liquidity than if you just put everything into a large CD. So hypothetically, you have $50,000 or $75,000 in cash positions. Instead of putting that all into one CD, you have the opportunity possibly of taking a smaller amount, $25,000, let's say, move into a one-year CD, take $25,000, move into an 18-month CD, and maybe $25,000 if you have $75,000 to put in, and move it into a 2-year or a 2.5-year CD. Tyler, am I missing anything about generating income from the CDs when you ladder them?
Not too much, Dean, but when it comes to how to create income from your investments in retirement, that's a question that pretty much everyone is going to have to ask themselves once they get into retirement, because they have to generate income in some form to be able to retire in the first place. And like you had mentioned, Dean, a lot of good things about CDs, but one of the first one here being CDs. Many people know CD stands for Certificate of Deposit. Almost everyone has heard of or knows what a CD is. And with CDs, some of the pros is that you know what you're getting. So it's a fixed interest rate over a fixed period of time. There's 1 month or 12-month CDs. There's 2-year CDs. There's 18-month CDs. They're all over the place in terms of the time period. But generally speaking, the longer the maturity, the longer the time period, the higher the interest rate that you're going to make because you lock your money up for a longer time period. However, right now, CDs are based on interest rates, and with interest rates being so low, you're not going to get too much interest payable from your CDs. So one of the pros of CDs is that you know what you're getting. It's a fixed rate investment where you can plan for it. It doesn't vary. You know exactly what you're getting. However, right now with CDs, we often think that there's better options out there just because CDs run the risk of inflation risk right now. That's one of the cons of CDs solely based on interest rates, because if some people, if they're very conservative and they retire, they roll over their 401k or they have an IRA, and if they were to go and take it out of the market completely and go all into CDs, then they might make 2, maybe 3% right now for a long-term CD. But yet, if inflation is at 2% plus, if they're withdrawing, say, 4% of their overall portfolio, then eventually they will run the risk of running out of money, and they might not even be beating inflation if they're only making 1 to 2% in CDs. Inflation is over 2%, then the rate that they're getting on their CDs isn't even keeping up with inflation. So with CDs, they do offer some interest, but right now with interest rates being so low, there's probably better options out there. CDs do come into play when people want short-term holding places for their investments. That's a pro to them, where oftentimes you can get a better interest rate in a CD than just keeping it in savings or checking or a money market account at your bank. But usually we don't like to see people holding a big majority in CDs with a majority of their retirement funds, just solely based on interest rates right now and the lack of interest they're probably getting.
Okay, another item that can be put into a laddered situation too, other than CDs, you'll see some people looking to fixed annuities. Basic fixed annuities, a 1 year, 3 year, maybe 5 year. Part of the reason they look at that is many times it'll pay out more than a CD. Secondly, you have with some companies an option of getting compounding interest versus simple interest that CDs typically give you. So what that means is a CD will typically give you simple interest at the end of the year. So if you have a 3-year CD, it might give you 1.5% at the end of year 1 on the original amount that you put into it. It'll give you another 1.5% at the end of year 2 on the original amount you put into it. And then again, it'll give you 1.5% in year 3 on the original amount. Whereas sometimes you can get a fixed annuity, not all companies, but there are some out there. And what they will do is give you compounding interest. Let's say they give you 1.5% at the end of year 1 on the original amount. And then the second year, they will give you 1.5% on the original amount plus the interest from the previous year, and so on. So that's compound versus simple. The other thing, too, is people will look at a fixed annuity over a CD if they want to ladder some basic cash positions, because it does give you some deferral. In other words, you're not going to be paying taxes on it until it comes to its closure, where a CD you will be paying out it every year. Okay, next thing we're going to talk about as far as creating income and generating income is Social Security. A lot of people understand this. They know that Social Security is going to be an income source in retirement. Unfortunately, a lot of people use it as their largest source of income in retirement. And, that a word of caution there is, we really don't know the 100% pure strength of Social Security in years to come. There's a chance that, we could be losing upwards of 25% of Social Security benefits in the future. Don't know if that's going to happen. It's something that we watch and listen to. You hear both sides of the fence on that, whether it's going to be there or not. But looking at Social Security, because it is such a big part of most people's retirement funds, don't be too quick to jump into Social Security without getting a second opinion. Talk to a financial advisor to model out your Social Security options. Optimize is the word we like to use. Optimize your options. In other words, get the best that pays out the most based on your own specific situation. Go to the Social Security Administration and ask for a benefit matrix. What they will do is, if you're close to wanting to take Social Security, they will run all of your options for a number of years out. You do have to go in person or schedule a time, an appointment to have this done, though. And it gives you options, whether you can take spousal options, whether it's your own option or a combination or widower's benefits. All of them are laid out for you. So don't jump too quickly into Social Security. Don't listen to everything that you hear and read. I hear some people say only take Social Security at 70. Well, obviously you're going to make more per month, but if you retire early and you have limited investments and you put your Social Security off until 70, chances are you're going to run those investments down to a critical point that it's probably going to hinder your retirement in later years. So look at your own situation. Don't listen to everybody telling you take it at 62, 66, or 70. It's based on your situation. Many times it's based on your debt situation. It's based on your living and your lifestyle. So for instance, some people have a very conservative lifestyle. They can wait to take Social Security, or if they've taken Social Security early, they have other means of income coming in. So again, talk to an advisor, have them go through it. We sit down and look at Social Security options all the time with clients or prospects who come in and want to talk to us to see if we can help them out. Tyler, anything else with Social Security as far as creating income?
Yeah, Dean, when we talk about Social Security, historically, that has been, Social Security has been the number one form of cumulative income for people who are retired. However, a lot of times with some of our younger clients, people who are in their 20s, 30s, 40s, when we model out their financial plan and their retirement plan, oftentimes I don't even include Social Security in there. And I say, guys, just because we don't know the status of what's going to happen with it in the future, it's best to save like it's not even going to be there. And if it is there, great. It's simply a cherry on top. It's that much better for your financial plan. But for our younger, our younger clients, we model it out as if it's not even going to be there, hoping that it obviously will. But then for those people who are retiring right now, the number one thing that you want to do is try and optimize Social Security. And many people, you can take it as early as 62 years old. And from 62 until your full retirement age, which for many people who are retiring right now, that would be 67. So from 62 to 67, it grows by about 6% per year each year that you delay and don't take it. And then if you want to wait even further than your full retirement age, even further than 67, then from age 67 until 70, it grows by about 8% per year. So you do get a higher benefit when you wait. But Dean, like you said, everyone's situation is different. So for some people, it might make sense waiting. Other people, it might make sense taking it early. One thing that we do is plug it into a retirement plan, and we can determine what your best option would be based on a number of different factors and kind of let the numbers do the talking there. But there's always going to be a break-even point, and again, that is for everyone to decide on an individual basis. There's no right or wrong answer, but the number one thing when it comes to Social Security, again, is sit down, go through your options. You don't want to make a knee-jerk reaction type of decision when it comes to filing for Social Security. You have to factor in a number of different things, such as your debt, your 401k and other retirement funds that you have, your health history, the genetics that you may or may not have on your side. There's a number of things that go into it, but Social Security is something where those people who are retiring right now, it is good to have a plan going into retirement so you know when you're going to file.
Okay. Tyler, before we go on to the next one, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, the next one we're going to talk about is a pension. When it comes to creating income, a pension is a wonderful benefit to have. Unfortunately, we see a lot of pensions going away. We also see a lot of employers no longer giving pensions to their employees. So there are some companies, there are some unions that have pensions that are stressed financially at this point. Usually when we have a situation like that where we have somebody who doesn't have a lot of faith in the pension payout because of their employer or because of the union and what has happened to it in the past, many times we'll take that opportunity to look at possible rollover options. Why? Because you just don't want to be taking a pension, retire in 10 or 15 years into your retirement, all of a sudden they reduce the pension, which can and has happened. But the other thing too with a pension, it really comes down to your option for taking income. And there are usually a number of options, but the two that are main focus here is joint versus single life. And a joint life is a variation where you have the person who has the pension receives a certain amount to pay out every single month, doesn't increase. You might get a cost of living increase depending on where the pension is. You get that same amount every single month. And if that pension holder should pass away while receiving the income, their spouse would continue to receive that payment for the rest of their life. It would either be 100% that they would receive, the spouse would, or it could be a reduced amount like 70%, 75%, 80, 50%, and so on. That is a joint life option. Do understand, though, that many times when both spouses pass away, most pensions then no longer pay out to anybody else. So if there's still some money left in that pension bucket when both spouses pass away after filing for joint withdrawals, what happens then is the pension company or the custodian who holds the money now retains the money that's left. So when you look at that, you have some decisions to make. The other one, though, as far as the withdrawal, is a single life. A single life means it will pay out to the pension owner, and if that pension owner passes away, it's done, regardless of how much is left in that pension bucket. So I tend to think the only time you're going to be interested in the single life option is usually, we've seen it a couple of times where we've helped people with their paperwork, and it's basically a person who is single, not married, has no family members at all, and wants to get the most they possibly can from the pension, and at their passing, they really don't have any place where the money is going to go other than in a estate, and they'll leave it up through probate, which is unfortunate. But again, single life would be a situation like that. We have heard people try to make the argument that they want to file single life because they get the most they possibly can, and if they're married, they think they are going to get a life insurance policy to cover themselves so their spouse has something to live off of. Sounds good in theory, but if you get a term policy and the term policy is 20 years and it terms out on you and you die in the 21st year, it really doesn't help your spouse. So we don't typically recommend anything other than joint life if you are married.
Yeah, Dean, good points there. But when it comes to pensions, now again, not everyone has pensions. A lot of companies are going away from pensions, but still we see many people who are retiring in the Green Bay area here. There are still quite a few companies that do offer pensions. And the number one thing is if you are going to take the pension in monthly installments, then you do want to choose the right option. And just to reiterate what you said, Dean, is whenever we have a married couple, almost every time the joint option is what we recommend. So where the pension payout might not be as much per month, however, once the pension owner passes away, then that payment will continue to go on to the spouse. Whereas single life, if you make that mistake and you get a higher payment when you're living, but then once you pass away, your spouse doesn't get anything. And usually that can ruin their retirement plan alone right there. So it's very important that if you are going to take the pension in monthly installments and you do want to choose the right option, and again, like you mentioned too, Dean, where many pensions, they don't pay out to beneficiaries once both spouses pass away. So unfortunately, if a couple retires at 65, one spouse passes away at 70, the other passes away at 75, then the payments are going to stop, and their kids, if they have children or whoever they want their beneficiary to be, their beneficiary won't get paid at all. The pension then would end at that point. Now, there are some options where you can have a certain amount of payments guaranteed, but generally speaking, you can't control the amount going to your beneficiaries once both spouses pass away in many situations. The other thing too is looking to see if the pension is stressed financially. That's another big thing. We have many clients who they might be teachers or they might work for the state or for the government, and they have the Wisconsin Retirement System pension. That is a lot more sound financially than the Teamsters pension or different other pension funds that are severely underfunded. So the number one thing to consider that if you are going to take the pension in monthly installments and not roll it over as a lump sum, you want to make sure that the pension isn't stressed financially and it's got very good funding, because the last thing that you want to do is have your whole retirement be dependent upon the pension fund when here, if you could control it, you would rather do that if the pension fund is underfunded or stressed financially. So that's something where you want to look at that. And then the last thing to consider with a pension too is there's math that you can do to determine if you would be better off rolling it over as a lump sum versus taking the monthly option, where you can go and you can look up what the payment percentages that they would give you each month if you were to take it as in monthly installments. and compare that to if you were to roll it over and have the lump sum grow, and you can do the math that way. So that's the other thing, where if you do have the option to either take your pension in monthly installments like an annuity, or if you have the option to also roll it over as a lump sum, you want to weigh that out too. Sit down, find an advisor who will look at the math for you, factor it into a financial plan, and do the right thing that way. But again, pensions for many people, it will create a good deal of income in retirement. And for those people that are fortunate enough to have pensions along with Social Security right now, they have a very good amount of fixed income in retirement, which is a good thing. But remember, with pensions, always want to do the math, determine how good financially the pension company is, and choose the right option when it comes to joint life versus single life.
Okay, good points, Tyler. Now we're going to talk about dividend stock. This is one that we do like an awful lot. This has something to do with your investments. The first three that we talked about are CDs, Social Security, and pensions. People are aware of them, but they really don't optimize them. And that's what we were talking about. Make sure you sit with somebody so you can optimize those options. But when we talk about dividend stocks, we typically like to stick with large blue chip stocks for stability. What happens is they pay out a dividend. This is a situation, though, that when you're looking at a dividend yield, many people typically make the mistake of shooting for the largest dividend yield they can possibly get, and then they become very disappointed that their portfolio isn't growing from a realized growth standpoint. And what I mean by that is, typically if the dividend percentage or the yield is very high, it usually means that the growth of the stock itself is usually suspect. It's usually flat lines or actually is going down. So, there's situations where Tyler and I will typically target about a 2.5% dividend yield. That way we get the best of both worlds. We get 2.5% dividend yield, could be 3% with some, could be less than that, but it also gives us dividend growers. We are very, very bullish on the fact that we like dividend growing stock positions in our portfolio. That way you will see growth opportunities on your statements from a standpoint of the market, and you'll also see dividends being created. And while you're not retired, reinvesting those dividends are a wonderful thing right back into the original stock that created them. Another option that we use is we take the dividends on some of the stock positions that we feel are overweight or that we don't want to have grow too much more in the portfolio. We want to start investing some other places. And if the client can no longer put any more money into the investments, what we'll do is stop the dividends from being reinvested, maybe have the dividends go into cash until we can pool enough cash through the dividends to go buy another stock position. So we can create some diversification by using those dividends. But again, in theory, you want to shoot for maybe 2.5%, 2.75% dividend yield. That way it'll give you an opportunity to have dividends and dividend growing stock.
Yeah, really good points there, Dean. Just to piggyback off what you said with dividend paying stocks that we look at, we don't only want stocks that have a dividend yield, but we want stocks that are termed as dividend growers. That should be the target, where you ideally want growth and dividends, not only one or the other as you're looking for income in retirement. So some people, if they're only trying to target the highest yield and the highest dividend, that could be a bad thing, because the higher the yield, that actually could mean that the stock price itself is decreasing. So there's people where you look at stocks, and again, I'm not making any individual recommendations here, but you have dividend yielding companies like AT&T or ExxonMobil, for example, where they pay a really nice dividend, which is great, but usually companies like that are well established, you're not going to find the growth in those companies. Whereas on the other hand, two companies as opposed to AT&T and ExxonMobil might be Microsoft or Apple. Those are companies that they pay a dividend, so they're dividend yielders, but yet they're also growing at the same time. And a lot of that too is simply based on the industries that they're in, where Microsoft and Apple are tech companies and the tech industry is growing. AT&T is telecommunications, ExxonMobil is oil. So those are two industries that aren't as much growth oriented as tech. So when it comes to dividend stocks, try and not only look for a good dividend yield, but you want yield to go along with growth as well. So that's the other thing, where if you want one or the other, that's fine. But ideally in retirement, you want dividends, but you also want your stocks to grow too over the long term. So dividend stocks are used to create income from your investments in retirement. That we really like dividend stocks when it comes to providing income, but you don't only want to look at dividend yielders, you also want to look at dividend growth stocks as well.
Okay, and the other thing too is it's not just the dividend stocks that create a yield or a dividend. You can get dividend exchange traded funds or dividend heavy mutual funds. For those people who really don't feel comfortable carrying single stock, that might be an option. For instance, the S&P index fund itself, if you like to invest in index funds, whether it be the Dow or the S&P or any other index, for instance, the S&P index and the Dow index funds all have a very nice dividend. So you're creating dividends by going with index funds too. Typically, if you start looking at the Russell and the NASDAQ, some of the smaller companies, you're going to see more growth opportunities than dividend there. So you can look at dividend exchange traded funds, you can look at dividend mutual funds, or dividend individual blue chip stocks. Okay, the next one we're going to talk about here is going to be real estate investment trusts. We had one show where we talked about this exclusively, but REITs, R-E-I-T-S, real estate investment trusts, they spin off a significant dividend yield typically, okay? Real estate investment trusts can be either liquid or illiquid. So if you're buying the REIT exclusively, make sure you look and are aware that it's either liquid or illiquid. Liquid meaning you can sell it. Illiquid means you cannot sell it until the real estate investment trust company determines it can be sold. And that can be dangerous at times because if the market is going down significantly on that REIT and you're holding onto it and can't sell it, you're going to drive it right to the bottom. So understand with REITs, if you want to get away from worried about liquidity or illiquidity, you might look at REIT exchange traded funds or, again, REIT mutual funds. You can take advantage of getting some significant income coming in the forms of dividend yields and interest, but yet you can feel comfortable being able to sell it at any time as opposed to carrying the individual real estate investment trust in an illiquid form.
Yeah, Dean, good point there. The last thing before we close out the show, bonds obviously are another type of investment that do provide income. We just covered that on one of our last shows here, but bonds too, they will provide income in the form of interest payments as well. But the main thing to take away is that there's many different forms of income that you can create from your investments. The number one thing to do is formulate a plan going into retirement so you know where your income is going to come from. We review plans for our clients all the time. We'd love to take a look. But again, when it comes to income, want to make sure that you have a plan going into retirement so that you're set and you can have a comfortable retirement when it comes to the income that you're going to generate.
Good points, Tyler. That's all the time we have this week. See you later and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.